Welcome back to the channel. I'm Andrew Lasky, commercial real estate investor and advisor specializing in retail assets. If you're serious about investing in retail real estate, you need to know how to properly analyze a deal. Whether you're looking at a $2 million strip center or it's a $10 million shopping plaza, the fundamentals do not change. In this video, I'm gonna walk you through the key metrics and terminology that you need to know in order to analyze a retail deal. We're gonna cover everything from NOI to lease structure to tenant credit and market demographics that actually matter when evaluating retail. This is the same exact framework that I use with my clients and also the team that I invest with to evaluate deals every single week. And today I'm giving it to you. If you find this information valuable, remember to like and subscribe so that you don't miss new videos just like this. Now let's dive in. Before we get into tenant names or traffic counts, you need to understand the income stream. In commercial real estate, you're not buying a building, you're buying a contractual stream of income. And the first number that you need to understand is the net operating income, or the NOI. NOI equals the gross rental income minus the operating expenses. So if a property generates $300,000 a year in annual rent and has $100,000 a year in operating expenses, your NOI is $200,000. This number drives the valuation. It's also how you compare deals across markets. Higher NOI relative to the price means a better return, but NOI is not everything. It's actually just the starting point. Next up, we have the cap rate, or the capitalization rate. This is the return that you would earn if you bought the property all cash with zero financing. The cap rate equals the NOI divided by the purchase price. In our previous example, if the NOI was $200,000 and you're paying $3.3 million for the deal, that's just over a 6% cap rate. Here's a few things that you should know. Lower cap rates equal higher price and more competition and a lower yield, while higher cap rates are higher risk, less competition, and on the exit, going to be harder to sell. In major metro areas like Miami, where I am based, or Austin, Texas, or New York City, retail may trade for as low as a 5% cap rate. In strong secondary markets, you might still find deals at a 6.5 or 7% cap rate with a lot of upside. Cap rate's important, but it's not the only metric. It does help you quickly benchmark a deal's return profile to see if it fits your criteria. The next thing that we're going to do is look at the rent roll, which is the X-ray of the property's financial health. Here's what it typically includes: tenant names, lease start and end dates, monthly rent, reimbursements for CAM, which is common area maintenance, taxes and insurance, rent escalations, and even renewal options. From there, we're going to look at three core things: tenant credit, lease structure, and the weighted average lease term, or WALT, and not the WALT that you're thinking of. So let's start off with tenant credit. Who's really paying the rent? Tenants fall into three different categories. The first one is called credit tenants. These are national brands like Starbucks or Walgreens. Their leases are essentially bonds. They're extremely safe, financeable, and highly desirable for investors. The second is franchise tenants. These are local operators that use a national brand. Think of Subway or Dunkin' Donuts, and the performance depends on that local operator's strength. The last is the mom and pop tenants. These are independent companies with limited financial depth. These can be really great or really risky depending on the business model and the lease terms. You want to assess not just who they are, but how replaceable they are. Are they a traffic driver, a destination? Can you easily backfill them? The next thing that's super important is the lease structure. Who's paying for what? not all rent is created equal. There are three main types of leases when it comes to retail. The first is the triple net lease. This is the holy grail of retail. Tenants pay base rent plus their share of property taxes, insurance, and maintenance. This is the gold standard when it comes to passive income. The second type of lease is a modified gross lease. Tenants pay the base rent and just some of the expenses. Landlords are still on the hook for things such as the structure, the roof, the parking lot. It's less predictable cash flow for the investor. And the third and final lease is the full service gross. Landlords cover everything. It's extremely rare in retail, but it can show up in some of these older leases. Going back to triple net leases for a second, you also want to check for things such as reimbursement caps. Check the leases. If they have reimbursement caps, there's a maximum that you can charge your tenant for expenses. And if the actual expenses do exceed that, you as the new owner will have to eat that remaining cost. Also, you want to know who is responsible for things such as the HVAC, the roof, and the structure. And when it comes to common area maintenance, are the tenants being billed for actuals or are they being billed just the estimates? Understanding the lease structure is key to understanding the true net operating income and also the value of the property. And the last thing is the weighted average lease term, or the WALT. WALT tells you how long, on average, the leases will continue, weighted by how much rent each tenant pays. So why does this matter? Well, the longer the WALT, the more income stability and the less risk. The shorter the WALT, the greater the risk as leases expire sooner. Typically, investors want a longer WALT unless the property rents are so under market that they get a massive discount on the property and can immediately increase the rent, increasing the value of the property, pretty much getting the property at a steal. However, if that's not the case and you invest in a project with a lower WALT, if several leases expire at the same time, you may face significant vacancies and enormous leasing costs. Remember that if you hire a broker to do leasing, you have to pay them between 5 and 6% of the entire lease. So make sure that you add that into your underwriting. Another thing that you have to be aware of is having the proper amount of tenant improvement dollars set aside when you're bringing on new tenants. To understand the right amount for your market, you'll need to contact a leasing broker. Next, evaluate the tenant mix because not all centers are created equal, even with similar numbers. Ask yourself, do the tenants actually complement each other? Are these daily need businesses? Are the tenants recession resistant? The ideal tenant mixes are restaurants, nail salons, barbershops, dry cleaners, urgent care clinics, dental clinics, national brands, and strong local service-based providers. You want to avoid overlap. So having like 3 sandwich shops in one plaza is extremely silly, right? You wouldn't do that. And beware if the center depends too heavily on one tenant, especially one with a short-term lease. Now we're going to zoom out a bit and we're going to look at the local market. What you have to take into consideration are the location fundamentals. When it comes to demographics, what does the 3-mile population look like? What's the median income? What's the household growth that you see over the next couple of years? What about the traffic count? This is an extremely important metric when it comes to retail. If the plaza doesn't have at least 15,000 cars driving by per day, me personally, I wouldn't touch it. What about shadow anchors? Is there a Target or a Publix nearby that's pulling in consistent foot traffic? What about competition? Is this the dominant retail plaza in the area, or is it just one of many? You want a location that is essential, visible, and stable. The real estate underneath the building is as important as the tenants that go inside it. Finally, always ask yourself, where is the upside in the project and what is the risk? Upside can come from many different things: leasing vacancies, replacing weak tenants, raising below market rents, improving operations through property management. Here are some risks that you want to watch out for. Tenant rollover in the same year. Co-tenancy clauses where if one tenant leaves, it triggers rent reductions for the rest of the tenants. Deferred maintenance such as the roof, parking lot, or even the signage. Hidden lease clauses that reduce future income. You don't need a perfect property. You just need one where you know what the risk is and you bake that into the price. Here's the bottom line. If you understand the rent roll, the lease terms, and the tenant mix, and you combine that with smart underwriting, you will instantly be ahead of 90% of investors that are chasing retail deals right now. This asset class rewards people that are educated about it and also those that are patient and can strike when a deal comes their way. If you found this helpful, hit the subscribe button, comment below, and get ready for the next video where I discuss the different type of retail centers that you can invest in. I'll see you in the next one.